Thanks for clicking. The Office of the Superintendent of Financial Institutions is proposing a number of rule changes, which will make it even more difficult to obtain a mortgage in Canada. The proposals offered by OSFI following a meeting this week seek to implement a number of rule changes, including limiting the number of risky mortgages that can be held on the books of Canada's banks. Like clockwork, within 24 hours of the announcement, Phil Soper, the president of Royal Lepage, took to the airwaves to express his discontent.
Don't talk to the press!
So what I want to do today is look at the proposals being offered by OSFI and how those proposals would be implemented, take a look at the reaction of the real estate industry, and then discuss what to look for next. We have a big week coming up with the Canadian Real Estate Association set to release the data on December's real estate market, and we're expecting to get Canada's CPI data coming out on Tuesday. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rules. Onto the mortgage rules. OSFI's proposals begin with the premise that mortgage lending in Canada has become riskier over the past few years. Given the amount of debt that has been taken on by Canadians over the past few years, Canada's federally regulated financial institutions, which hold approximately 80% of Canada's mortgages, have been exposed to increased risk as well. Indeed, with insolvencies up, though defaults aren't up yet, we'll discuss that later, there are signs that a growing number of Canadians are struggling to manage their debt. As such, OSFI is growing increasingly concerned about the stability of the banks, not the real estate market, and is proposing a number of changes, a number of new limits on mortgage lending by financial institutions. So what is OSFI proposing? First off, OSFI is proposing a limit on the number of high loan-to-income and high debt-to-income mortgages that financial institutions can hold on their books. Right now, though not regulated as of yet, lenders generally consider 450% to be a high loan-to-income ratio. So if you make $100,000 a year and you borrowed $450,000 to buy that home, the lenders would consider that to be a high loan-to-income ratio. And OSFI is proposing that there be a limit placed on the number of these high LTI, high loan-to-income mortgages that can be held on the books of these financial institutions. And how would the lenders implement this? Although we don't have any official word as of yet, I would expect the lenders to go by credit score. It won't be a first-come, first-served basis where the lenders have a certain level of LTI mortgages on their books and then they can't take any more.
And yet, no more!
No, I don't think it's going to be like that. I think the lenders are probably going to implement this via credit score, where you have to have a certain credit score, be it 690, 700, in order to qualify for a high loan-to-income loan or mortgage. With that said, we don't have any official word on how these are going to be implemented. These are just proposed rule changes coming down from OSFI. Second, OSFI is considering targeting debt-to-service restrictions. Right now, the mortgage lenders on insured mortgages restrict what percentage of a borrower's income can go towards servicing their debt, can go towards servicing their GDS, that is the amount that goes towards their home, and their TDS, the amount that goes towards all of their debt payments, their home plus all of their other debts. Right now, that restriction is 39% on the GDS, the amount going towards the home, and 44% that goes towards everything else, including the home. However, uninsured mortgages, those mortgages with 30-year amortizations and those mortgages where you take money out of your home vis-a-vis a refinance, those are not currently regulated by OSFI. However, OSFI is very much considering putting those numbers, putting those GDS and TDS limits into regulations so the banks, the financial institutions, won't be able to make exceptions on that 3944. There'll be hard and fast rules. Further, similar to the loan-to-income ratios that we just talked about, OSFI is also considering limiting the number of high GDS and high TDS mortgages that the banks can hold on their books. So, like we just talked about, there would be a limit on how many 38.5% GDS mortgages that the banks could hold on their books. And third and finally, OSFI is considering major changes to the current stress test, to the MQR, the minimum qualifying rate. Right now, we have a minimum qualifying rate of 5.25%, and during the pandemic, many borrowers qualified at 5.25%, even though their mortgage rates were closer to 1.5%, 2%. But a lot of those same borrowers that qualified at 5.25 did so on variable rate mortgages. And with rates rising to 6.45%, if you had prime -1, you're now paying 5.45%, higher than that 5.25 for which you were stress tested. As such, OSFI is considering changing the stress test so that it's applied differently across various terms and products. For instance, OSFI could mandate that variable rate and fixed rate mortgages are stress tested differently. Since variable rate mortgages, as we're seeing, carry more risk, OSFI could mandate that it is much more difficult to qualify for a variable rate mortgage than it is for that of fixed.
I am never going to financially recover from this.
So, in summary, OSFI is considering limiting the amount of high loan-to-income and high debt-to-income mortgages that banks can hold on their books. They're considering limiting the amount of high debt-to-service ratio loans that can be held. And they're also considering major changes to the stress test. Stress testing different loans differently based on their differential levels of risk.
There's an idea!
But how were these proposals received by the real estate industry? Bloomberg asked Royal Lepage President Phil Soper what he thought about the changes, and the response was predictable.
Well, it's actually disappointing. If you look at the actual default rate, people who have been unable to meet the demands written into their mortgage, it has actually decreased significantly. We're down to something like 0.14, less than a quarter of a percentage people. And banks have been tightening lending practices. I just don't see the indication that it is warranted to push more people out of the market right now when young people in particular are having a tough enough time to get a mortgage. It seems overreach, personally.
Very quickly, first and foremost, as we've talked about on this channel before, OSFI's rules, OSFI's proposed changes, OSFI's mandate is to protect the banks, to protect the financial system. Anything that happens to the real estate market because of OSFI's rule changes is collateral damage. It's incidental. That's not OSFI's mandate. OSFI's mandate is to protect the banks. Second, yes, Soper is correct. Defaults are low for now. But a growing number of reports are showing that this may not be the case for long. And although economists and analysts rarely agree on anything, there is almost a near universal consensus that a recession is coming, that a recession is in the cards both globally and in Canada for 2023. Yet this isn't mentioned by Soper or Bloomberg whatsoever. Is Soper predicting that a global recession or a US recession or even just a Canadian recession will have zero effect on the default rates here in Canada?
Don't talk to the press!
The real estate market, the economy as a whole, is not strictly one-to-one. We have to consider as many factors as we can. The data is right there. Almost everybody, universally, is predicting a recession, and yet Bloomberg doesn't ask about a recession, and Soper doesn't mention one either. We just look strictly at these rule changes, completely neglecting the rationale for the rule changes that are coming to the fore in the first place. The future is obviously unpredictable, but OSFI is proposing these rule changes for a reason. It's not because the default rate is currently low. They're worried about the default rate that's coming. That's coming with the recession that everybody, almost everybody, agrees is coming to a theater near us. They're putting in these rules to protect the banks. It's a preventative measure. With all of that said, these proposals are just that, proposals, and will not come into effect, if they come into effect, until after OSFI's consultation period, which ends on April 14th. The real estate market, the banks, the mortgage market could change drastically between now and April, and we'll obviously continue to have updates out on those changes on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.